Cool. What's up, everyone? So my name's Adam Davis, and welcome to Fintech Insider On Air, episode 27. Thank you so much for joining us last week. We had a bunch of people live and even more watched afterwards, so thank you again for all your support. Last week, David chatted to Caroline Plum from Fluidity about cash flow forecasting for SMEs. It was a good episode. Go check it out on David's Periscope and on the 11FS YouTube channel. Clearly, David isn't here this week, but I'm joined by the man from Del Monte himself, Mr. Jeff Tijssen. Jeff, how are you?
I'm very well, thank you, sir.
Excellent, good news. This week we're going to talk about mortgages, and to talk about this we have a great guest, a man who's in the news at the moment, Mr. Daniel Hegarty, from the CEO of Habito. How are you doing?
I'm wonderful, pumped to talk about mortgages.
But you've never done that before.
Never.
No. So we'll kick it off straight away. I think everyone wants to know. I was reading it this morning in the Financial Times. You've had some pretty big news. What is it?
So yesterday we launched our own range of mortgages. So we finally built the the full stack digital lender that we always hoped we would. So from yesterday at 8 a.m. you can go to habito.com and get a Habito mortgage. A few of the benefits of it are we think we can complete the transaction in about half the time of a traditional mortgage lender, mainly because we've digitized the full process. And in doing this, we raised about £500 million worth of debt, so we could lend it to people like Jeff. We're super.
Some of it.
You were a few weeks too late. Then.
We were trying.
I know.
But that's like no small task. So when you say you can half the time, what does half the time mean in real world?
So on average, it's about 21 days from submitting an application to getting an offer. We think we can do it in about 10 to 11, and that's partially through digitization, partially through because we're the broker and the lender in this case. There's not duplication of process. Partially because we've just partnered with the most new school of conveyancers and valuers and services and so on.
Cool.
So what was the rationale for doing this?
I think what we realised pretty early on was to wreak the fundamental transformation of the mortgage market that we wanted to achieve. It wasn't going to be enough to be a broker. It wasn't going to be enough to give good advice and aggregate products for people. We were going to have to own the full stack. But the mortgage stack is pretty terrifying, just in terms of the sort of capital intensiveness on the debt side, because mortgage is big, and also in terms of just it's a crazy market. We've talked about it before, but there are no pipes, there are no APIs, there's nothing that makes any rational sense. So to join those things together is no small task too.
Well, I was saying this earlier. I think to most people, you're the CEO of Habito. To me, you're like a personal therapist, right? So it's been quite enjoyable to have these conversations.
I'm here for you, Jeff. You can go, dude.
I was going to launch into it, but I won't. No, just to wait my fit. So, £500 million debt facility, that is quite the undertaking. You're acting as the broker and obviously now the lender as well. Mm-hmm. Are you slightly concerned that the regulators are going to be sniffing around that, or are you... How's that working? How's that landed?
That's exactly the right question. So there's two bits. So firstly, we got permissions from the regulator, the FCA, to enter into mortgages back in January of last year, and obviously we had these very same conversations with them. The super helpful thing is mortgage advice is a regulated activity. So whenever we give mortgage advice to anyone in any capacity, we're always required to explain precisely why we chose that one, why we didn't choose the other one, why it's appropriate, why you're eligible for it, why it's affordable. So nothing changes here. So if the case isn't that the Habito mortgage is the right one for you, then we're not going to recommend it. And in every piece of advice we give a thing called an evidence of research document that shows precisely why this one.
Cool.
So we were, I think both from the regulator's perspective, but actually more importantly from our perspective, we could get comfortable with it.
Cool. I've got 100 questions on this. I'm just going to keep firing.
Brilliant.
So I'm the host now. Someone made a decision. Foolish. Why start with BTLs?
It's a good question. So we think it's just a hugely underserved segment, as you well know, Jeff. So you've got, there's 4,000 different products, but they're all identical. Mm-hmm. And actually, there's been zero innovation in that space or any other. One of the reasons we really liked it is that the process of getting a BTL tends to be worse than for residential. So residential tends to take about 14 days, BTL 21 days. So actually we felt like we could make more of an impact quicker and demonstrate the capacity of this platform. So the new origination platform that we've built, so our digital lending stack, this is just the first deal for BTL, but we're looking at a residential product in the next sort of 6 to 9 months, and also looking at direct partnerships with existing retail banks who might want to utilise our platform, utilise our new rails for the mortgage industry.
Okay, cool.
Interesting.
But we wanted to prove that we could do something difficult first.
So if I'm Jeff and I'm sitting on a lot of mortgages, and I want a nice 10-year. Are you going to be able to offer a 10-year fixed rate BTL?
We've got 7 years and 10 years.
Oh my God!
We're also going up to 80% LTV as well for the mortgage geeks in the room. It's pretty exciting stuff.
The room's on fire. It was hot before, and now it's just steaming. All right, awesome. That's very cool. So you're looking at the like the revenue stream from providing, I guess, what is commonly known now as a PaaS or BaaS product, but you're looking at taking your capability and obviously then selling it to the wider market as such.
Exactly. So we wouldn't see ourselves. So we are the lender of record. It's not like a SaaS solution that we'd be selling to a retail bank.
Cool.
But in essence, instead of us giving the advice and sending the application to the lender, we would do all of the underwriting, all of the kind of the papering of the mortgage itself, and just send them the asset. So for the customer, all of the kind of seams of the experience that make it painful disappear. And for the lender, they save a huge amount of direct costs in the processing of the mortgage and the replication of the work that the broker does. And they just get the underlying asset, which is what they wanted anyway.
Cool.
Where were you a couple of weeks ago then? If I would have had this literally 4 weeks ago, it would have made my life so much easier. So I've been quite vocal about the fact, I've had well, not just one, but a number of different shit experiences when it comes to mortgages. Now you and I have spoken about. We went through this the other day when we did a mortgage sale for Fintech Insider, but we've been through a couple of stats. So let's just run through some of the key ones. And this is based on some of the research that you guys have done.
Yes, I don't agree with
that. so more than half of UK households could be saving an average of £300 a month by remortgaging. So about £3,500 a year. We add it all up across the country. That's £15.5 billion of unnecessary interest being paid by families. And 97% of first-time buyers report that they are worried about purchasing a home. And then 62% of consumers report that they have suffered from mortgage-related stress. So that's 5.4 million Brits. What's mortgage-related stress?
I think it's what it says on the tin. There's another stat, which is that actually 10% of those 6 million people, so 600,000 people, reported that they'd stopped having sex with their partner due to their stress levels.
Were you one of them?
That is crazy. I mean, it's kind of outrageous, is the honest truth, and it's also kind of interesting given that we're at historic lows in terms of the cost of mortgages. They've never been cheaper, but actually the process is so difficult, so traumatic that consumers are just unwilling to switch. They'd rather stay on the wrong mortgage than go through the pain of applying for a new one.
That is, Matt, and in fact, that's a good segue. So the next point we wanted to move on to was what's going on in the mortgage market currently. Because if you take entering the market, it's kind of an anti-pattern to what's been in the news recently, which is some of the big lenders, Tesco obviously being one, who are looking to sell their book. If you look at some of the influences on that, you've got obviously the Brexit and the sort of the movement of interest rates. You've got sort of, I suppose, more entrants flooding the market. You've got the ring-fence banks, so HSBC flooding the market. So why now, I suppose? I mean, is it just sort of the evolution of your product, or is it more that this is like the right environment to do it in?
No, so I'd be lying if I said we timed the market to take advantage of ring fencing and so on. So no, this was always the kind of fundamental aim of what we wanted to be as a business. But no, the market's in quite a strange place. So as you say, even though rates are historically low because of ring fencing and the likes of HSBC having tens of billions of pounds worth of capital they need to deploy inside the UK. Actually, the cost of funding more generally is going up. So if you've got these top 6 lenders who are holding 70% market share, they're having a wonderful time. The other, whatever it is, 130 lenders who have the other 30% are looking at margin compression, increased competition, the likes of, not to be blowing our own trumpet, but the likes of Habito as a broker kind of driving honesty in rates and making sure you can't get away with hidden fees or obfuscatory pricing regimes. It's a pretty tough universe for lenders. And I guess, we're not going to be able to compete with HSBC on price. That's not going to happen. But we certainly can compete on service and experience. So I think we're trying to, I guess, focus on the things that matter to the customer beyond just how many basis points you're saving.
So how do you see this playing out in the next couple of years? I mean, as Adam mentioned, with Tesco effectively looking to sell their mortgage book, what's your view on how the mortgage space will evolve in the next couple of years?
I think we're going to see a consolidation. So I think you're going to see the building societies run into some real trouble, given the kind of regulatory situation and their lack of other kind of ancillary kind of revenue lines. I think HSBC are looking to go from, I think they're about 6% now. I think they want to be in the low kind of teens. So I think there'll be a drive of consolidation into the big six. But I think more interestingly, that other 30% is going to be, I think you're going to see new kinds of institutional capital coming to market. And I guess our first product is an example. I think you're going to see large global financial institutions, whether insurance companies, pension funds, asset managers, deciding that actually now that there's a route directly in to acquire UK residential mortgages that which yield similarly to infrastructure debt and are a lot less risky, why wouldn't they come to play? And their balance sheets are vast, compared to the retail banks.
You're not going to tell us where the funding came from, are you?
No.
Okay.
Clearly. There's about 600 pages of NDAs there, so.
Okay, I was looking for the scoop, but fair enough. We'll move on. In terms of the mortgage journey itself, so I've just gone through going through a remortgage at the moment. It's painful, I'm not going to lie. I've got to the point where I've sort of agreed the deal with one of the big boys. They've just then handed it on to another conveyancer who's obviously not had the experience that I've had. We've just run through beforehand, and we might do, if we've got time at the end, run through my list of fees and actually the jargon busting that goes through to understand how much I'm actually paying. Where, I suppose, within your lending process, are you looking to specifically help customers? So where are the real key pain points at the moment, and where are you looking to address that with the products that you're going to be offering?
Sure. So the first thing that we've kind of tried to do away with is this thing called the decision in principle, which you may have heard of, or the mortgage in principle, which is a kind of like pretty fatuous term for, maybe we might lend to you contingent on 100 factors. And actually every time we talk to consumers, even more than speed and simplicity, what they want is certainty, because they're in a stressful transaction or in a chain and they just want to know that this is a solved problem. So we've replaced that with what we're calling the Habito instant decision. So instead of it just being a few markers, we're actually going through, I think, over 100 credit rules. We're doing an automated valuation of the house in real time. We're doing the soft credit search in real time, as well as all the KYC and AML. So actually, when we say, we think we can lend to you, the only thing it's contingent on is the house being where we think it is and the valuation coming back as we would imagine.
Cool.
So that takes a huge amount of time out of it. And then actually after that, it comes down to quite simple things like digitally instructing a valuation, digitally instructing the conveyancer, rather than it being a letter or a fax in some cases. Yeah. There is one conveyancer that we got some feedback recently who, in the bottom of their email signature, said they only print out their emails at 3 p.m. every day. So we shouldn't expect a response, which is extraordinary. That's today, this year.
I love that. It's like convincing on your own terms.
Why are you printing them out?
What a process. What's led to somebody putting that on the bottom of the... Well, anyway. So why are you printing it out in the first place? Quite true. Okay, cool. So you're talking about the AIP, the decision in principle. Is there anything that you're looking to do? Because one of the things that's kind of not necessarily annoyed me, well, it has annoyed me, I'm not gonna lie, about the mortgages that I've got at the moment, is once I get them, I never hear from the lender again.
Yep.
So and then in order to actually look at what my statements are, or to understand where how much capital's left, or whatever like that, it's a whole laborious process to try and get onto an online banking, which is a separate credential. If you bank as in your current banks with the current provider, it's a separate credential and all sorts of. So are you looking at engagement post getting the mortgage? And if you are, is that going to hit into your costs? Because obviously NIM's moving only in a certain way, blah, blah.
Yeah, no, so I think just the basics, and you're right, the basics are not covered. So being able to check your balance, change your repayment date, surprisingly complicated.
Yes.
Understanding what would happen if you were to overpay and what that would do to the eventual term of the mortgage and the cost. All of those things are kind of built in for us at the beginning. And I think that's just the kind of, for us, that's just the kind of hygiene level of operating in this market, which, I guess given just the way the retail banks are organised, mortgages don't have a place in the internet banking stack as it stands, but because obviously it's native to us, it's much easier to achieve that.
It's amazing. Even the concept of overpaying is alien to some people.
It's also, it's the last thing the banks want. Do you know what I mean? So there's also, they don't really want you moving your direct debit around that has a direct cost. And really, the only time you hear from them is if they want to refinance you onto another fixed rate, because that makes sense.
Yes.
So I was reading your Medium post from yesterday, and so a couple of interesting things you said. So the problem is that the mortgage industry doesn't have any pipes, nothing fits together, nothing is standardized, and nobody is incentivized to help the next person in the chain. And I think that to me perfectly describes what one of the key challenges when it comes to getting a mortgage. Because to me, the lack of visibility of so where am I? So if there's 10 steps throughout that journey, from speaking to a mortgage provider or a broker all the way through to getting the actual mortgage, I just have no clue in terms of where I am. Right? So even when we just got our BTL mortgage, again, I was the one who had to chase my mortgage provider to get an update on where we were, and we're getting really, really close to the actual date at which we had to close the mortgage. So it was just a pain in the ass. To talk to me about like what are some of the other problems that you're seeing in the industry? So what are some of the things that are wrong with the existing mortgage process?
That's a good question. So I guess just to take the broker and lender relationship, for example. So as a mortgage broker, you have to go through full KYC and AML on the customer. You also need to effectively underwrite the mortgage. So you figure out, so you make sure you send it to the right lender and they don't lose 3 weeks being declined. You also need to go through a full affordability check. So that means collecting all of the pay slips and bank statements and make sure they correlate and the mortgage is affordable. And once all of that is done, you package it up and you send it off to the lender and they do it all again, like from scratch, plus the credit search and plus the instruction of the valuation. So even there, even with best endeavors and everyone just trying to do the right thing and protect themselves and the next party from first or third party fraud, like you've lost like 2 weeks in every transaction. So I think it is both a kind of the burden of making sure that you're not passing fraud down the chain that makes things difficult, but also just the kind of completely onerous governance and risk and compliance practices for everybody. And by the time you get to the conveyancer, he's going to want to KYC you again, right? So he wants to see a passport and a utility bill.
Yes, he does.
And from this year, estate agents are going to have to do it as well. So that's going to be like 4 times you're going to go through a passport.
Right.
So I guess. And it's hugely challenging to try and integrate these different parts of the chain. But if you can, I guess, so by integrating the brokerage and the lender and now the instruction of the valuation as well, we can go some way to doing that. The one that's really difficult is conveyancing. So even if we come up with a brilliant conveyancing solution, there's always the other guy, because there's always 2 lawyers in the transaction.
Yes.
And so if that guy's only printing his emails out at 3 p.m., like it doesn't matter how quickly that we operate. So.
Could you operate both sides of that, or is that's definitely a no-no?
You could do it in a remortgage. You can act for both parties, so effectively the lender and the refinancee, but you can't do it in a purchase transaction.
So how did you manage to overcome some of those challenges? I mean, looking at the new solution that you guys have built.
So which ones in terms of the chain itself? So the first thing is, and again, without going too deep, so. People think that that mortgages themselves have criteria. They actually don't. Lenders have criteria. So you either qualify for a Halifax mortgage or you don't, and then which product you have comes down to specific criteria. So what we've been able to do is actually bake in all of the full stack of like underwriting criteria and KYC criteria into the product definition, if you like. So instead of saying, oh, we think you probably need a 2-year fixed rate, let's collect another 30 fields and then send that off to the lender and then we'll find out what they say. We're able to say at the point of you coming into our funnel, actually we know with like 99.9% certainty that this product is going to be available for you. So you can move quickly and with certainty on your transaction.
Okay, so you and I spoke about this the other day, Dan, but why have we not seen more innovation in this space in the past couple of years?
Why would you need to? Like it's the perfect market. Like every Brit's obsessed with home ownership and has been forever. Nobody's going to let like the pain and kind of the friction of getting a mortgage get in the way of them, like, you know, painting their family life on the canvas of their beautiful first home and so on. Like it's such an integral and fundamental like desire for, I think, particularly the Brits to own. The mortgage market's been able to operate like this for 30 years with literally zero innovation and just the replication of each other's products, because people aren't going to stop getting mortgages. To
that point though, as NIM gets, well, the trend at the moment that it's going down per mortgage, do you see any diversification of revenue? I know you're going for you're looking to take what you've built and obviously give it to other lenders, which is one way to do it. But in terms of the actual mortgage journey, do you see any differentiation in terms of how people could, in future, I guess, diversify, bring in other services, build new services, adjacent services, or do you think it's kind of talk from a product perspective, but in the end, it's just the fundamentals that matter?
I think you have to be really cautious. I think the kind of like the grand cross-sell of garbage that nobody wants is can end up being really negative as well. One thing that we did last year is we launched our own life insurance product. We partnered up with AIG to do that. And we felt like that was like such a kind of coherent, to use gobbledygook, but a coherent kind of adjacency to getting the mortgage. Like you really need this life insurance policy, that we felt comfortable kind of layering that into the journey. I think by the time you're like trying to sell them moving services and an architect to do the extension, like you're a little bit out of your lane. So I think where the buildings insurance I think makes sense because you need it for mortgage, life insurance because you're taking on this huge debt and you want to protect your family. And I think equally we're looking at a few other ideas that might allow us to even further accelerate the process. So potentially by saying, look, well, why don't we just front you the cash so you can be a cash buyer, and when your mortgage comes through, we'll pay our own loan off.
Cool.
That might be a premium service that you could offer to kind of substantiate more yield.
Cool.
How do you align? So just looking at the different players who are involved in the process. So how do you align incentives to make sure that every single player who's involved in the process end to end ultimately focuses on doing what's best for the customer, as opposed to I just care about this bit of the journey, as opposed to focusing on that end-to-end journey?
I mean, it's very difficult, right? So if you work from the back, so the conveyancer only cares about their own liabilities, so they're not particularly interested in customer outcomes. They're just trying to make sure they get paid and they don't get in trouble. So that's difficult, very difficult for us to influence. Valuation, I think you can influence, and I mean that is a pretty broken market with lots of people driving around on mopeds and actually just popping into the estate agent and asking how much it's worth rather than coming to their own determination by. And we can definitely trust the estate agents. There's nothing to worry about.
Sounds solid to me.
So I think again there's just people trying to collect a paycheck and not get in trouble.
Yes.
So I don't think they're working against the interests of the customer, but they're certainly not working for them. I actually think for me, like the largest kind of influencer is more around like product innovation. So just like another 2-year fixed rate, another 5-year fixed rate. Like sure, we can get a better process, a quicker process, a more certain process. But at some point, I think we just have to examine whether these are the right products for customers. I mean, we're the only country in the world that's refinancing every 2.5 years.
Yes.
Because we were on a 2-year fixed rate. That's an insane amount of time to be thinking about your mortgage.
Of course.
Yeah.
So I'd be super interested in seeing 10, 15, 20, 25-year fixed rate products coming to market, which don't have egregious prepayment fees that make that are portable, but that just make this a solved problem for customers rather than making them have to intellectually engage with this value chain.
And go through the process again every year. Yeah. Okay, get it. Cool. Should we play some Bargain Buster? Django Buster?
Are you going to use the ones you did before?
Django.
I might be in trouble.
I might do. So, just for everyone's knowledge, so this was, I got some conveyancing forms 2 days ago, 70 pages. In Appendix 4.
Only 70.
Only 70. In Appendix 4, they outline their fees, additional fees and services information sheet.
Sounds good.
So there are 34 fees.
Jesus.
I'm supposed to know what these are. So I ran through a couple of these before with Dan, but I'm going to
mix it up.
Well, a couple of them I'm not, because some of them are just so ridiculous that I just have to mention it. What is drafting RX3/RX4 fee, which is going to cost me 50 quid?
I haven't got any idea.
No.
I can't believe you don't know that.
Yeah, I'm deeply embarrassed.
All right. Here's one I did ask you. What is staircasing?
So staircasing, so if you're in a shared ownership property and you have the opportunity to take a larger share of it over time, there is an administrative fee that goes along with that.
Okay, that's 300 quid.
Yeah, it's not cheap, not cheap.
Okay, checking solar panel lease fee. That's 75 quid.
I'm guessing you don't have any solar panels?
No, I think you're
all right. I hope they're not charging you to check.
Okay, here's one, because you said what this was, which makes sense. Telegraphic transfers for redemption of existing mortgages, a fee of £30.
So this is outrageous. This is an old CHAPS fee. So do you remember CHAPS when we used to not have faster payments? And they're still charging, even though I don't think anyone's used CHAPS for anything under £1 million in the last 5 years.
This is crazy.
Why is
there 34 fees?
You've gone full Jeremy Kyle. This is crazy.
This is unbelievable. But it's incredible. Unregistered fee, £95. I don't even know if some of these are even going to apply.
Unregistered for what?
I don't know.
Nobody knows.
27, unregistered fee, £95 plus VAT. I don't even know what that is. What is this?
So this is why their mission, quote, is to set people free from the hell of mortgages.
Bless you.
Which I quite liked.
Cool. Okay, I think that's probably it. I'll do the outro. You can tell I've done this a lot. That's all we have time for this week. Where can people find out more from you?
Head over to habito.com for a glorious array of mortgage advice, mortgages, life insurance, anything else you might need.
Awesome.
Personal therapy.
Exactly. Just call me. It's fine. I'm around.
Dan will sort out every one of your mortgages. Jeff, where can we find more of you?
On Twitter at Jeff Tijssen.
Talking about beach sets and stuff. And then myself at AdamD8 on Twitter and obviously at 11fs.com. Thank you for tuning in. If you want more insights like this, why not listen to our Fintech Insider podcast? It's available on all your favourite podcast providers. Next week, David will be back. You'll be happy to know. So if you want a topic discussed on air, hit us up on those emails, tweet, DM, get in touch with us, let us know what you want to listen to, and we shall make it so. Thank you very much.